Most people are introduced to money through effort. Work more, earn more, save what remains. The entire model is built around input and output. Time is exchanged for income. Energy is converted into money. It feels logical. You work and you get paid. You stop working and the income stops. This creates a simple understanding of wealth. More effort should produce more money. More hours should produce more income. But this model has a limit, because time is limited, energy is limited, and effort does not scale beyond a certain point. No matter how hard someone works, there are only so many hours in a day, and once those hours are filled, income stops growing. This is where the difference between income and ownership begins to appear. Income depends on participation. Ownership does not. Ownership introduces a different structure. Instead of earning money directly through time, ownership allows money to be generated through systems, assets, businesses, investments. These are not tied to constant effort in the same way labor is. They continue producing value even when no direct work is being performed in that moment. A business can generate revenue while the owner is not present. An asset can appreciate in value without daily intervention. An investment can compound over time without continuous input. This is the first shift from effort-based income to system-based income. One requires constant participation. The other continues operating beyond it. This is why the two paths feel similar at the beginning but lead to very different outcomes over time. Both can start with work. Both can start with income. But one remains dependent on effort, while the other begins building something that functions independently. And once something begins functioning independently, it introduces a new dynamic. It removes the direct link between time and money. That link is what defines most financial lives. Time in, money out. Ownership begins to weaken that connection, and when that connection weakens, something else becomes possible. Income that continues without constant effort, value that grows without constant attention. This is not visible at first, because the early stages often look identical to the effort-based path. Work, earn, save. But underneath that surface, something different begins to form, a structure that is no longer entirely dependent on time. And that structure becomes the beginning of something much quieter, an engine that does not rely on constant effort to keep moving. Ownership changes how money behaves. It stops being something you only earn and starts becoming something that works. An asset is not just something you possess, it is something that produces. It creates cash flow, it appreciates, it participates in economic activity even when you are not actively exchanging your time in that exact moment. This is the structural difference most people do not see early enough. Labor produces income once. An asset can produce value repeatedly. That repetition is what changes the direction of wealth. A business generates revenue from customers. A rental property generates income from tenants. An equity position participates in the expansion of a company. A bond produces yield. Infrastructure produces cash flow as long as it remains connected to demand. Different assets behave differently. Different risks exist inside each one. But they all share one important characteristic. They separate value production from direct, hourly effort. That separation is quiet, but it is foundational. Most people are trained to think about money through effort: work, earn, spend, repeat. So they naturally assume more money comes from more labor, more hours, more pressure, more output. And for a while, that model appears to work. Income rises, the paycheck grows, life improves. But the structure underneath it never changes. The person is still attached to the income source in a direct and fragile way. If the labor stops, the income usually stops. If the hours shrink, the money shrinks. If the person burns out, the system slows down immediately because the system was never a system at all. It was effort wearing the appearance of progress. Assets change that relationship. They still require thought. They still require capital. They still require risk tolerance, timing, selection, and management. But once they are in place, they do something labor cannot do at the same scale. They continue. They continue producing. They continue appreciating. They continue operating inside larger economic systems that move with or without your presence. That is why assets are not just possessions. They are productive structures. And productive structures create a different relationship with time. A person can only sell the same hour once. An asset can produce across many hours without being resold every day. That is the beginning of leverage. Not dramatic leverage, not reckless leverage, structural leverage. The ability for value to keep moving without requiring the same effort every single time. This is also why ownership often looks slow at the beginning. The first asset rarely changes everything. The first investment rarely looks transformative. The first small business may produce only modest returns. But the early stage is misleading, because the visible result is still small while the structure underneath is becoming more important. What matters in the beginning is not the size of the return, it is the change in mechanism. The person is no longer relying only on labor. They are building something that can function beyond labor. That is the real shift, and once that shift begins, wealth stops depending entirely on how much effort can be forced into a week. It begins depending on how many productive systems can be owned, directed, and expanded over time. This is why assets sit at the center of the quiet engine. They do not just store value. The right assets produce it. They connect capital to activity. They connect ownership to demand. They connect time to repetition. And repetition is what makes the engine quiet, because value is no longer being created only in visible moments of work. It is being created in the background through structures that continue operating after the initial effort is finished. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video. Subscribe. More clarity is coming. Compounding is where the engine becomes difficult to see. Because nothing dramatic happens at the beginning, the early stages look small. Returns feel insignificant. Progress appears slow. An asset grows slightly. Income increases marginally. Reinvestment seems almost unnoticeable. From the outside, it does not look like an engine at all. It looks like patience. This is why most people underestimate compounding, because it does not announce itself. Compounding is not a single event. It is a process where value builds on top of itself over time. Returns generate additional returns. Growth feeds future growth. Small increases begin stacking. And at first, the effect is barely visible because the base is small. If an asset grows by 5%, the change is minor. If it grows again, the increase is slightly larger. If that continues, the increments begin to expand. Not because the rate changed, but because the base did. This is where compounding separates itself from linear income. Labor grows in steps, raise by raise, hour by hour. Compounding grows in layers. Each layer builds on the previous one, and over time, those layers begin to accelerate, not suddenly, but structurally. This is why the early phase often feels slow, because compounding requires time before it becomes visible. Most people evaluate progress too early. They look at the first stage and assume the system is weak. But the system is not designed for immediate impact. It is designed for accumulation. Each cycle adds more. Each return increases the base. Each reinvestment expands the structure. And eventually, the change becomes noticeable, not because effort increased, but because the system itself gained momentum. This is the moment where compounding becomes visible, when the output no longer feels proportional to the original input. At that point, the engine is no longer small. It begins producing at a different scale. But by the time it becomes obvious, the process has already been running for years. This is why compounding feels invisible to most people. They are looking for immediate results instead of long-term structure. Because compounding does not reward impatience, it rewards continuity. It requires consistency, time, repetition. And once those conditions are met, the system begins to accelerate without needing a proportional increase in effort. That is the quiet shift. Effort no longer drives growth directly. Structure does. And when structure begins driving growth, wealth starts moving in a way that is no longer tied to individual output. It begins to follow the system itself, not the effort that started it. By the time the engine becomes visible, it is already well in motion, not because something sudden happened, but because something consistent was allowed to continue. Ownership was established, assets were put in place, value was allowed to compound over time. None of these steps look dramatic in isolation. Each one appears small. Each one feels manageable. But together they create a structure that behaves very differently from effort-based income. Effort produces results once. Systems produce results repeatedly. And repetition is what transforms small outputs into something significant over time. This is why the engine remains quiet, because it does not rely on visible intensity, it relies on continuity. The same asset producing again and again, the same system continuing without interruption, the same structure expanding slowly beneath the surface. Most people miss it because they are looking for visible effort. They are looking for moments where something obvious happens. But the engine does not operate in moments. It operates in duration. It builds through time, not through intensity. This is also why it is difficult to recognize early, because the early phase looks almost identical to ordinary financial behavior. Work, earn, save. The difference is not in the surface actions. It is in what those actions are building underneath. One path maintains income. The other begins constructing systems. At first, both paths appear similar. Both require effort. Both require discipline. But over time, they separate, because one remains tied to continuous input, while the other begins producing independent output. That separation is gradual, almost unnoticeable in the beginning. But as time continues, the difference widens, not through sudden change, but through accumulated structure. The system begins doing more of the work. The assets begin producing more of the value. The individual becomes less tied to every unit of output. And this is where the quiet engine fully reveals itself, not as a single strategy, not as a moment of success, but as a system that continues operating long after the initial effort has been applied. Wealth, at that point, is no longer something being chased. It is something being generated. Not loudly, not suddenly, but continuously. If this changed how you see wealth, subscribe. Like this if it clarified something.